Hi folks, this is Deepak Shenoy from Capital Mind and we'll talk about the sovereign gold bond scheme today. This is a special scheme that many of you are aware is in the market, but hardly anybody knows what it really means. But let me try and explain in a very simple way. The idea is to buy bonds instead of gold. Essentially, somebody is giving you a bond that will replace physical gold. This is somebody is the government. It is a bond that will behave exactly like gold in the sense that if gold prices go up, the bond's price effectively goes up, and if they go down, they effectively go down. The difference is that you don't need to store this gold. If you purchased it from a jeweler, you would need to store it. You don't have any wastage, which is what the charges are if you, for instance, buy jewelry or buy gold in certain formats. There are no purity issues. So you buy from one jeweler, take it to another, he tells you it's not really gold. The risk for you is that the government will default, and there is really no risk of the government defaulting in rupees. But let me take you through the salient features of this bond, the risks involved, and everything that's out there. So some of the features that you would want to know is you can buy a minimum of 2 grams, a maximum of 500 grams. Each gram costs about 2,500 rupees. So 500 grams would be 12.5 lakhs. That's the maximum you can buy in this bond. So each bond is one gram, and then you can buy multiples of a gram. You get a holding certificate which can be dematerialized as well, so you can put it in a demat account. This is an issue that's not on tap, in the sense you can't walk into a bank anytime and say I want a gold bond. It's going to be in tranches. The first tranche is between November 5th and November 20th of this month. There's a reason for that, and I'll come to it. The way you will buy is you will pay according to a previous week's average price of the Indian Bullion and Jewelers Association gold price. So this is last week's price of average of Monday, Tuesday, Wednesday, Thursday and Friday. They will notify that price, and if you've paid excess, they will refund accordingly. You receive an interest on this invested money. Okay, so this is not a full interest which you get in a bank, but you get 2.75% a year. Half of that is every 6 months, so it's like a semi-annual coupon. This is typically how government bonds are paid for anyway. After 8 years, the bond is automatically redeemed and the money goes back to your bank account. But you can also redeem it after 5 years at every time there is an interest payment. So, twice a year. You can take loans on these bonds. These are treated exactly like gold loans. So the bank will give you an interest as if the underlying was gold. If you sell the bond, and you could sell it in the market after 3 years, for instance, or redeem it after 5 years, the idea is to tax you exactly like you were holding physical gold. So you will actually pay long-term capital gains on holdings for 3 years and more, short-term on less. You get gold indexation if you, purchase indexation if you hold hold this bond for about 3 years or more. Now, there is one thing that's different. This interest that you get, 2.75%, is taxable, but there is no TDS on it. So you will have to pay your tax at the end of the year yourself. You can apply through a bank or through a post office or through an NSE agent. A couple of other people are there as well. There is nothing online that I can find right now, but it's impossible for this bond issue to currently go online, I suppose, but you will eventually be able to buy this online as well. One of the things that you have to note over here is that it's only open for individuals, not for companies, not for any corporates, not for non-resident Indians, and not for FIIs and so on. So it's only for individuals, maximum of 12.5 lakhs, minimum of approximately 2 grams, so that's about 5,000 rupees. One thing here is that there is no gold that backs this. So they're not saying give us money, we'll buy gold on your behalf. No, the government is saying, listen, if gold price goes up, we'll make up the difference. If the gold price go down, you're going to take the loss, but the government's taking the risk on its own. There is no hedging either, so they're not going to buy like a gold put option or a gold future to hedge the price of gold if the price of gold goes up. But it's probably a smart thing, and I'm going to tell you why it's a smart thing, because of a very peculiar nature about India. But before that, as a buyer, how is it? This is way better than any other instrument that you can purchase. If you buy directly from a jeweler, and let's look at the rest of the instruments that are out there. If you buy it from a jeweler, you'll be charged a making charge, and that could be 5%. There's a 10% spread between the price the jeweler buys and the jeweler sells. So if you buy from him and sell it back to him on the same day, you lost 10%. They have issues of purity, because you don't know and you're not a goldsmith to recognize what the purity issue is, and you have to take and store this gold. So sometimes a coin or a bar may be stored. It can easily be stolen, so you have to be careful about it. You have to get a locker or a store well in your house and be careful that nobody steals it. The gold bond does not have any making charges, does not need to be stored. It can be dematerialized. There are no purity issues, obviously, because it's marked to the price of gold, the price of extremely pure gold by the IBJ. And there is no bid-ask spread. They pay you exactly the same price as there was the last week, the average of the last week's price. You could say that, listen, we could buy a gold ETF, exchange traded fund. For this, well, you know what? Gold ETFs have a 1 to 2% fee every year. And this includes things like storage charges, and there are probably other charges that they add to it. And so over about 10 years, you're talking about a 2% fee that will add up to a 20% lower price that you can achieve over 10 years than the price of gold. So if the gold price appreciates by 20%, you will actually make nothing, because you're paying this 1 to 2% fees a year. There may be a repayment risk, and this has not happened so far, but in certain cases, some ETFs tend to have their gold in vaults that they trust, but sometimes those vaults can be compromised, sometimes economically, sometimes physically, and you don't know whether you'll get your money back. And we've seen this situation happen in another exchange, but it is a risk that is there. Obviously, there's no annual fee for a government bond. You don't pay. In fact, they pay you 2.75% interest. And there's no repayment risk because it's the government. The government has not defaulted ever. A gold mutual fund is just like a gold ETF but has higher fees. So again, you don't pay annual fees on a gold bond. What about buying gold futures? You could buy gold futures. It's a exactly similar product. There's no gold backing it. It's just a future. But you have a much higher lot size. You can't buy in 1 gram, 2 grams and all that. Of course, there's no upper limit, and that's an advantage. But you also have to pay mark to market and margins. So if gold price falls, you have to pay the exchange, the difference. You need to roll over your trade. So you'll maximum get about 3 months ahead. So after 3 months, you got to roll over and buy another one. In the process of this rollover, you will lose some money, because when you roll over for the next 3 months, you will pay what is called a forward charge, and that typically adds another 1 or 2% as a cost. And if you're going to pay 1 or 2% every 2 months, that's 8% a year. That is not, it's like adds up and becomes like an annual charge. A gold bond again has no need for rollovers. I sound like an advertisement for the government, but this is not it. I'm just looking at the features. You can buy gold that's actually backed by gold in an exchange like NSCL, but you know what? The NSCL is already defaulted, and we don't even know if people have received their money back. You just don't want that kind of risk on what is supposed to be a safe saving. Where's the risk though? If you look at the risk from the government, from the buyer perspective, the government is shouldering all the risk. You're taking the risk of the gold price falling. The government is taking the risk of the gold price going up. Now, to the buyer, this is the best and safest investment possible if you are comparing this with buying physical gold like a bar or a coin. This is simply safer than any other avenue available. For the government, it's much cheaper borrowing. They're taking money from you. They don't have to buy gold. They can do whatever they want with it. Now, when they take money from the market, they pay 7%. They're paying you 2.75%. Sure, they're taking a risk that gold goes up, but there's a peculiar nature of gold in India that makes it worth the risk for the government, according to me. And let's see how. Okay, so we believe the risk is worth it. India is the world's largest importer of gold. Well, China is coming close, but we're very, very big out there. We are like 20% of the world market, and it is our second biggest import after crude. Second biggest import. Now, if we cut the imports of gold, there are two things that will happen. The price of gold will fall because we are the largest importer, we are the largest consumer in a way. If we were to consume 20% less gold than was consumed earlier, you're obviously talking of a massive disbalance of supply and demand, and yes, prices of gold will fall. India's imports will reduce substantially, again because it's the second largest import for us. That reduces the pressure on the rupee to fall, because if you reduce your imports, your exports remain roughly the same. You are effectively controlling the demand for imports and therefore the demand for the dollar, and therefore you will free the rupee in a way that it will appreciate. So remember, of course, that gold will go up to you only by two factors: because of world gold demand. Remember, this is driven by India and China. India's 20%. Rupee depreciation as well, because if the gold price remained the same, the rupee fell from 50 to 70, you're talking of a 40% increase in the price of gold in rupees. If both factors are addressed, and if they will be if we cut gold imports, then guess what? This is a safe risk to be taken by the government. And if you notice recently, ever since inflation has come down, if India has managed to bring inflation under control, the demand for gold has died. This is Q2 2014, that's the June quarter of 2014 versus 2015, same quarter. We're talking of a 15% drop in world consumption. 30% of that, Indian consumption has fallen, in the sense we're seeing 52. I think this is this is 52 tons and versus 36 tons that is in Q2 2015. So we're talking about a 30% drop. And if you look at the world, the world consumption itself has dropped from 237 to 201. So that's a 36-ton drop, out of which we were responsible for 16. We were half of the world's drop. And the gold price, as you know, has dropped substantially. India does drive gold prices worldwide. And if these gold bonds were to be successful, they can help cut imports. They will only help cut bar and coin imports. People will still buy jewelry, but you hope that a company that manufactures jewelry and imports raw gold will continue to import raw gold, because they have to make the jewelry, but at least the demand for bar and coins comes down substantially. India imports about 200 to 300 tons of bars and coins a year. This is about 20 to 30% of world gold consumption. Okay, so it's a pretty big number. If we are able to replace it, we can cut our imports, we can cut the gold price as well. What will it really cost the government? Now, this is an interesting point, because you don't want the government to keep losing, because in the end, we pay through it to the taxes, right? Now, if you assume that there are 300 tons of gold, all of it goes through this. That means all of India's bar and coin imports are replaced by the gold bond. Let's assume that, just to see how much the biggest risk is for the government. At 2,500 per gram, that's about 75,000 crores. Okay, and for 75,000 crores, we're talking about 2.75% versus 7.5% that they pay in the market. So they save about 4.75%. That's about 3,500 crores per year in interest that Indian government pays less compared to borrowing it from the market. Remember, the government borrows more than 4 lakh crores from the market every year at 7.5%. They can save a substantial amount by paying only 2.75%. This in 5 years, assume the period of this loan is 5 years, you're talking 17,500 crores. If gold appreciated by 23%, there is no loss to the government in this entire 5-year period. Even if the gold imported appreciated by double, by 50%, 2,500 became 3,750, which is very high. But let's assume that it happened. It's still, the loss is 17,500 crores over 5 years. That's nothing. That's 3,500 crores a year. Maybe take 4,000 crores a year. We pay 10x that much for a subsidy for food, which is probably going to increase to 80,000 crores next year. right? So you're talking about a food subsidy of 80,000 crore versus removing all of India's gold imports of bars and coins for a cost of 3,500 crores per year. This is absolutely very little, and gold on average has increased, and largely because Indian demand has increased. If you remove Indian demand, you are unlikely to see gold prices go up by that much. So rupee impact and the lower gold import prices is probably much more than worth it. So this is a question I leave you to answer, but our view is that this is absolutely the best replacement for physical gold coins or bars. There is an impact on the this is great for investment for your children and for the future, but there is of course an impact on the fiscal deficit if gold prices were to shoot up suddenly. But we do believe that for the buyer, that is not really a concern right now. This is great for replacing physical gold coins or bars. We don't like gold as an investment because, honestly, if this scheme and the others that they have got succeed, gold is a dead investment worldwide. I think we've been saying that for a while, but your view could differ. No, we don't question why people should own gold. We just say that this is a better investment to be able to invest in gold. There are good reasons for gold to go up. We've had quantitative easing in the West that could make people go after inflation, make prices go up, and if that happens, people may shift to gold, and gold prices could go up. Central banks could convert some of their dollar holdings to gold. This is likely to happen, but we see a very small probability of this happening. If things improve in the world economy, then people will not go to gold. They will go to stocks or debt, but not to gold. Do visit us. We hope you like this presentation. We have a bunch of things that you will like at Capital Mind Premium. Do take a free trial. We have a 30-day trial available. We have a bunch of newsletters, macronomics, option analysis, our virtual portfolio, which have done more than 70% a year. We've got smart caps, which are stocks chosen by our community, and we also have a bunch of other stuff, including stuff that comes in your inbox, email on a regular basis. We've got our proprietary data platform called Snap and much more. Visit http:/capitalmind.in/subscribe. I would love to see you there, love to hear your comments. Do let us know. Thanks for watching.